Return on assets, or ROA, is a key measure of a company's profitability. It tells you how efficiently a company is using its assets to generate profits. Think of assets as the tools a company uses to make money. These tools include things like factories, equipment, and inventory. A high ROA is a good sign. It means the company is using its assets effectively to turn a profit. A low ROA, on the other hand, could be a red flag. It might mean the company is struggling to generate profits from its assets. Investors use ROA to compare different companies and make investment decisions. A company with a higher ROA is generally considered a better investment than a company with a lower ROA, all else being equal. ROA helps you understand how effectively a company is being managed. Are they making smart decisions about their assets? Are they generating good returns? ROA can give you valuable insights. Calculating ROA is relatively straightforward. The formula is ROA equals net income divided by total assets. Net income is the company's profit after all expenses have been paid. Total assets represent everything the company owns. Let's say Company A has a net income of $100 million and total assets of $500 million. Their ROA would be 20%, which is $100 million divided by $500 million. Now let's compare that to Company B. Company B has a net income of $50 million and total assets of $200 million. Their ROA would be 25%, which is $50 million divided by $200 million. Even though Company A has a higher net income, Company B has a higher ROA. This means Company B is more efficient at using its assets to generate profits. ROA is often compared to another profitability metric called return on equity, or ROE. While both measures assess profitability, they focus on different aspects. ROE measures profitability relative to shareholder equity. Equity represents the portion of the company's assets financed by shareholders' investments. In simpler terms, ROE shows how effectively a company uses the money invested by its shareholders. The formula for ROE is RO equals net income divided by shareholder equity. A high ROE is desirable as it indicates the company is generating a good return for its shareholders. However, a RO alone doesn't tell the whole story. Unlike ROA, RO doesn't consider a company's debt. A company with a high ROE might be using a lot of debt to finance its operations. While this can amplify returns, it also increases financial risk. ROA is a powerful tool for investors. It can help you identify profitable companies, assess management effectiveness, and compare companies within an industry. When analyzing ROA, consider these tips. Look for trends. Has the company's ROA been increasing or decreasing over time? A rising ROA is generally a positive sign. Compare to industry averages. How does the company's ROA compare to its competitors? This can provide context for its performance. Consider the company's industry. Some industries naturally have higher or lower ROAs. Don't rely on ROA alone. Use ROA in conjunction with other financial ratios and metrics for a more comprehensive analysis. Remember, investing involves risk. While ROA is a valuable tool, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any decisions.